Fireside Chat. Liquidity is reshaping private equity, and our guest, Mustafa Siddiqui, is at the forefront. He is the founder and CEO of SQ Capital, a firm focused on middle market, secondaries, and GP-led transaction. In this conversation, we explore his vision for the firm, the forces transforming the secondaries market, and how private equity is evolving in an increasingly liquidity-driven world. Mustafa, thank you so much for taking the time and joining us today.
Pleasure to be with you.
So I have to admit, I was about to cancel the interview after I read one of your posts on LinkedIn that said everything. So I'm going to use it to start the conversation, if you don't mind.
Okay.
So, you made a comment about how pre-2022, some PE firms rushed to deploy capital, and perhaps, without paying attention, you call it the original sin. So I want to ask you, how much has this structural gap or this condition convinced you that it was the right moment to set up and launch SQ Capital, which now is celebrating its first year?
Sure. Khalid, I think the structural gap was there in any case. I think this phenomenon that we talked about, which we'll come back to, that really informed the strategy and the edge, right? How you shape the edge given the market conditions, the market environment that you're coming into with a new secondary strategy. And so I think to go back, why go launch a secondaries firm, especially focus on the middle market? I think there were really two gaps in the market that I saw that to me combined felt like a once in a career type of market opportunity. And the first was that generally speaking, the secondary market was growing. But the opportunity set was growing much faster than the capital formation. It was an undercapitalized market. And because of those tailwinds, what you saw was that you ended up with a big gap in the middle market for secondaries. So that was the first gap. And why? Because almost a large portion of your incumbent secondaries players over the last 10 to 12 years, they went from having $3, $4, $5 billion funds to 20, 25, $30 billion funds, right? That was a tailwind that they rode. And so suddenly all these players were up here, and that rapid movement left this gap down here in the middle market. Of course, there were still some players, but really, I mean, a handful relative to the scale and complexity of the opportunity set. So that was one gap. The other gap that I saw was for an alpha-oriented secondaries strategy in a market that has traditionally been applied by very beta-heavy secondary strategies. And by that, what I mean is the traditional secondaries playbook was really a heavily indexed type of approach, right? Buy a diversified index of private equity funds. Maybe you buy at a slight discount to the GP's marks. And with those two variables in place, you then ride the beta. And what I saw, and this goes to your opening point about the pre-2022 behavior on the part of GPs, throughout the 2010s, if you had this sort of indexing-based, beta-oriented secondary strategy, it was amazing. Because during the 2010s, every private equity fund did well. Everything went up and to the right. So beta was very much your friend. But then once the cheap money went away and suddenly, the wheat was starting to be separated from the chaff, that's when suddenly now, if you look at the market environment today, private equity beta is no longer your friend, right? There's much wider dispersion in terms of underlying company performance, fund performance, and even the valuations and the marks. And so then the important thing became to be, as I saw it, and this is how we shaped our strategy, to be able to go through on a more of a bottom-up basis rather than a top-down basis and be more of an asset selector, not an indexer, but a stock picker in the secondary market. So that was the other gap. And I had a particular background combining direct private equity with GP stakes and kind of underwriting funds and GPs that led me to believe that I could go build that different kind of secondaries firm and the kind of team required to do that.
you just said something about selecting, and this is, how you're basing your vision for SQ Capital. How much does this AI native angle that you describe SQ Capital with, using a proprietary system called Score with a Q to evaluate opportunity is important? How does it, change really the decision-making process compared to a traditional bottom-up due diligence method?
It's a great question. I think the first thing I'll say is, in response to your question, the traditional secondary method isn't in fact bottom up, right? The first thing is we've created this broad bottom up underwriting process for secondaries, and so what role does Score and then our broader data science and AI strategy play in this? So if you take a step back, we literally, when we're buying an LP secondary, we're buying a fund, an interest in a fund or multiple funds, we are going through and we are forming a view company by company. We did a transaction recently where we bought a handful of funds. There were 83 portfolio companies in that fund. And we went through and had a view on performance, outlook, exit, valuation on each of those 83 companies. Now, one thing that I was very mindful of as I was developing the firm and really designing the firm from a blank sheet of paper to optimize it to our strategy was that on the one hand, we want to be a bottoms-up fundamentals-based investor. But recognizing that that just takes fundamentally more work than the traditional secondaries approach, which is much more top-down, the tension that I was trying to resolve was, how can we be a bottom-up fundamentals-based investor while still moving faster than the competition? Because there's a tension between amount of work versus speed. How do you break that tension? And the answer lay in bringing in 2025 vintage data science, AI capabilities, now 2026 vintage. And one of our biggest advantages was we were a firm that was being born in 2025 with all of this technology available to us. And we were then able to attract talent from Tiger Global, from Lightspeed, that was deeply immersed in really at the cutting edge of the application of data science and AI in the investment process. So without getting into too much detail on Score and how we use it and what we do, really what it does is it allows us to go through our bottom-up fundamentals-based process, but do so much faster with more data and information available to us than the typical secondaries approach, and hence more insight that we're able to generate to inform our investment and buying and pricing decisions.
And when you look at whether it's your LP-led secondaries or your GP-led continuation vehicles that you focus on in the middle market funds, I'd say, do you seek to balance between the two in terms of portfolio construction, or are you mostly opportunity driven? And also, what differentiates the selection process in both types?
Another great question. So we're trying to build a you say balanced portfolio, balance between LP interests and continuation vehicles, mainly single asset continuation vehicles. And so 50-50, 60-40, something like that. And the good news is we see really tremendous deal flow across both those areas. So then to the second part of your question, what are we looking for in each of those areas? Ultimately, Khalid, we're looking for the same thing, right? And this is and what is that? It's underlying high quality businesses in the hands of GPs who are capable stewards for those businesses with a clear right to win. And this is a bit of my, you could say, heresy when it comes to secondaries, right? I don't view secondaries as some magical, like esoteric instrument. It's just a wrapper. I mean, it's simply a channel, right? But ultimately, what are you buying? You're buying the same thing that a primary private equity investor is buying. You're buying exposure to underlying companies, and you're paying, hard cash for those companies. You're just buying it through the secondary channel. And as it happens, this is a channel that is less competitive, but undercapitalized, and therefore a more attractive channel to be buying through. And so whether you're buying a single company through a single asset CV or 83 companies through a handful of LP interests, either way, you're buying companies. And so, and which again is why I think it's critically important to have that bottom-up due diligence underwriting capability go company by company. It's why we've built our whole team on the deal side comprised of people who come from direct buyout backgrounds and really blue chip, really well-trained buyout investors who know how to analyze companies, who know how to value them independently so we don't have to rely on the GP's marks. But then put that together and what are we looking for both single asset CVs and LP interest? As I said, it's about underlying company quality and then the GP that's managing that.
And so what does a SQ Capital case study look like? You've talked about, buying bulk like 83 companies and also looking at one single underlying company. How do you manage that? And exactly how do you bring your deals together?
So in the case of an LP secondary where you're buying, let's say 4 or 5 funds with more companies in them, clearly you can't have the same degree of, every company will not be a trophy asset, right? But what you're trying to do is, if you've got a normal distribution in the markets that's this wide, you're trying to buy the funds where the distribution of quality of underlying company and the valuation is weighted towards, let's say, top quartile, right? And of course, there'll be outliers in both directions, but you're generally trying to shift and narrow your distribution curve for the LP interest by going through and really selectively, fund by fund, identifying the funds that you think are weighted towards quality at good value. And by the way, that compares to the traditional secondaries approach of buying 30 funds at a time, 50 funds at a time, without really much discernment or discrimination between what companies are in the underlying funds, or really an independent view on value. On the single asset CV side, obviously there's an opportunity to be really selective and do your work in detail on the companies and really build a bit of a greatest hits album, right, of some of the best companies in the middle market. And that's what we've been aiming to do. And I think we've made good progress in that respect. We've actually done 2 single asset CVs already. And as I said, we've bought a bunch of LP interests as well, which reflect the approaches that I just talked about.
And as a newly established firm in a competitive secondaries landscape, what are the biggest challenges and how are you managing them from day one?
The first thing I'll say is it's actually not such a competitive secondaries landscape. And I think that's part of the beauty of this. You could talk to any number of bankers in the space and they'll tell you, they'll say they're seeing the same thing that we're seeing, which is for roughly every dollar of deal value that transacts in the secondary market right now, and you had $226 billion last year, more than $2 of opportunities come that don't transact. So only roughly 1/3 of the actual opportunity set is transacting, and it's largely, and this is what you hear from the bankers who see all of this flow, it's largely because there isn't enough capital to go around. Now you zoom in on the middle market where we play, where it's even more undercapitalized, right? Because I think you've probably seen some of the statistics, but I think more than really 3/4 of secondaries capital formation has been concentrated amongst funds that are bigger than 5 billion. And really, I think it's something like 65% in the hands of the 5 biggest players. And so but then the irony is the middle market, as we size it and calculate it, represents roughly 3/4 of the total addressable market. So only a fraction of the total capital formation is being directed towards the middle market. So you can imagine how lonely it is down here, right? It's just actually not very competitive. We're often, it's just us. The first continuation vehicle we led with a really world-class middle market GP, was a proprietary transaction. And it just illustrates, I think, one, the value proposition and the relationships we brought to bear, but then also the fact that there aren't tens or hundreds of players falling over each other in the way you would find in other sectors. And also, I think the competition level at the big end of the market is higher simply because you have these huge players that are highly motivated buyers of anything that comes to market that's sizable, because they almost, they have a lot of capital they need to deploy into larger transactions. So then that is so going back into your original question, what is the challenge? Actually, probably one of the biggest challenges is that the volume of deal flow is like nothing I've ever seen in my entire career, and that's 26 years, right? And so how do you sift through all of this deal flow and identify the opportunities that really meet your eye and your quality bar, and then focus in on those? That is where our data science AI platform gives us some significant advantages from a rapid screening standpoint and an execution standpoint, and also where it's helpful to have a team that comes from a direct investing background on the underwriting side, where we have judgment and pattern recognition around what do good businesses look like and what are the warning signs of mediocre or bad businesses, and then also what does a true right to win for a GP look like? Which playbooks are really effective versus the playbooks that are just marketing stories? So our ability to sift through that with the benefit of our pattern recognition, and then of course our knowledge of these middle market GPs, our relationships with them, it allows us to, I think, be more efficient in that screening and really hone in quickly on the opportunities that are the higher quality ones, and then go after them aggressively.
You focus on the quality of the businesses. Is getting a big discount as important, or is it simply a good business with a lower discount is better for you?
The quality of business is important. We're not as motivated by that initial discount to the headline mark, because the reality is, one, that headline mark is often off in either direction. I've seen GPs whose marks were 30% too conservative, some that were 30% too aggressive, and only by doing the bottom-up work did you know which was which. And so just because you have a 20% discount to NAV, the GP's mark, doesn't necessarily mean you got a good deal. You have to do the work on the underlying companies and valuations, right? And so our focus is, one, on the quality of the underlying companies, and of course the GPs that are managing them, and then making sure that we're coming in at a price that is a discount to the intrinsic value of those underlying companies, rather than the arbitrary marks that often aren't very aren't necessarily accurate. And then the other aspect is, now, why quality companies in the hands of quality GPs? Because then your return is driven by not just a discount you come in at on day one, which gets you a nice day one markup and a nice high IRR on day one, but then your return is also driven by the subsequent compounding accretion and value of those companies. A lot of secondaries firms, what you'll see is their returns, because they buy at this discount to the mark, they mark it up. Day one IRR is astronomical, but then it does this over time. Mm-hmm. We're trying to come in where, yes, a discount is nice, that day one markup is nice, but then we want that IRR to stay elevated because the underlying companies are great businesses that are still compounding. So that's why we focus on what we focus on.
And if the volume of secondaries is so large, how do you think it will evolve in the coming years in terms of the supply-demand, the dynamic, and how do you see it impact exactly the pricing, the underwriting standards, and also the quality of assets in general?
I think the undercapitalization will take years, decade plus to address. And remember, even as the capital is forming, the addressable opportunity set is also growing, because what is your addressable opportunity set for secondaries? It's your installed base of private equity AUM, right? It's all the NAV that's already in place. That's growing every year. So, and that's why the capital formation can't keep pace. So if you look at it's an amazing statistic, but last year was another record year for secondaries market volume, right? $226 billion. Yet dry powder, and then there's all these headlines about, there was all this secondaries capital fundraising, and the capital is flowing into secondaries. There's a flood of capital into secondaries. What happened? Secondaries dry powder actually came down slightly over the course of 2026 in absolute dollar terms, even as the market activity grew dramatically from 160 billion the prior year. So that undercapitalization problem is not going away anytime soon. It's literally less than 1 year of dry powder. Yeah, dry powder for secondaries today represents less than 1 year of market activity.
And there's another point that's with the continuation vehicles. There's some criticism that comes along and say that there's a risk of non-alignment with the GPs. So for you, coming from the LPs, I mean, but for you, what are the non-negotiables you require from a GP before backing a continuation fund? And do you see some structural weaknesses in any case?
For us, it's always important that the GP is doing right by their existing LPs and approach them with a high degree of transparency. That they're giving them the clear opportunity to either stay along for the next leg of the journey or take their capital, right? And I think most GPs understand the importance of that, of doing the right thing for their LPs. I think sometimes some maybe try to game the system a little bit, and if we catch wind of that, that's something we tend to stay away from, right? A CV is intended to be a solution for everybody, right? For the LPs, for original LPs, for the GPs, and you want to make sure that that's how it's being implemented.
And going back to what you mentioned earlier, do you see that the PE exit playbook is broken in certain segment? And how do you see the long-term scenario for the secondaries?
I don't think that it's the playbook that's broken. I think it's just, and this goes back to you asked about my comments on LinkedIn recently, right, about the pre-2022 and the original sin, right? It's not the exit playbook is fine. Some of the GPs that I'm closest to and that I've done that I've partnered with in the past or recently, right? They've had record years for exits over the last 2 or 3 years, record years. So, and last year was a huge M&A year. So the market is open for business. So it's not that the exit playbook is broken. It's just that a lot of GPs got a little ahead of themselves, and everybody felt like a genius in the 2010s because anything you touch turned to gold. And so they started buying companies, and they had a lot of capital to deploy, and there was a bit of a frenzy. Financing was cheap and available, and so they bought stuff they shouldn't have bought. Poor companies, companies that don't have that don't have great long-term prospects. They overpaid for them sometimes. They over-levered them in many cases. And any combination of those three ingredients means those are very difficult companies to sell, at least without taking a significant write-down. So then the question becomes, are these GPs willing to kind of take that write-down? When do they become willing to accept that reality and kind of confess that sin, right? And I think that will take some, as long as you can kick the can down the road, it's rational to continue to do so. So I think that's what's happening. It's not that the exit playbook is broken or the market is closed. It's that GPs don't want to sell these companies at the prices people are willing to pay for them that really reflect their true value. And so they're holding on to them for longer, hoping that they're playing out the option.
If we continue on this point and referring back to your LinkedIn post, you said that some of these companies are unsellable, and the theme of zombie companies has become widely spoken within the PE industry. What percentage, if any, of the deals you look at, you would say are zombie companies, and could you extrapolate something of the general market and the risk to the market if they're over leveraged as well on top of that?
First of all, going back to the history of the continuation vehicle, right? The continuation vehicle, the original use case for it was actually the zombie company, right? A continuation vehicle used to be called a GP-led restructuring because it was used to extend the life of companies that were not saleable, needed more time to become saleable, and so they would get put into these GP-led restructuring vehicles. Then they started using continuation vehicles to also hold on for longer to some of their best companies. And that was a phenomenon of the past 5-7 years that became more common. And that now, so what we see in the market, I think the CV market is a good kind of data set to answer your question, I would say 20% of the companies we see are in some shape or form zombie companies. Of course, none of them are messaged as zombie companies, right? You have to do the work to figure out. It's a bit of a it's a bit of a treasure hunt to figure out, okay, or scavenger hunt to see, okay, where are the bodies buried, and is this a zombie company, or is this a trophy company the way it's being marketed? But I would say of the CVs we see, 15-20% would probably qualify as companies that are likely impaired for a long time. I think the majority are so-so companies, right, that are probably saleable today, but not necessarily at the price that the GP wants, and so they want to hold on for longer and try and sell in the future. And then it's really, I would say, 15-20% that are the trophy companies. Now that's still a lot of companies. But I think that this notion that I think a lot of secondaries investors have put out there, oh, everything's a trophy company, and therefore we're just going to go buy, I'll do all these CVs. I think that's wrong, because I think you need to be much more discerning. I think you need to really look very carefully and do proper buyout style diligence on these CVs to really understand which are truly the trophy companies you want to own for a long time, or you want to own for a few more years, versus the ones that are just dressed up like that, but are likely to disappoint you as you get to know them better.
More and more secondary transactions are now with complex syndications. And so what role do you see syndicate partner play in secondaries, and what does an optimal syndication strategy look like for you?
So this is a very interesting question, because I think that, and again, this will be a little controversial, but which may serve you well. But I think the syndication market is in for it, because the fact that a syndication market exists for CVs is simply a sign of how immature and young the CV market is, right? Because in what other market in the world do you know of where one or two parties do all the work, lead the CV, or lead a transaction, and then everybody else has to come in and kind of free ride off of that work and put money in? Doesn't happen, right? And so I think the reason that happens is twofold. One, most of your traditional secondary buyers are low conviction buyers, in the sense that even when they're leading the CV, right, they're doing it not because they did the diligence on the company thoroughly, buyout style, and really have a lot of conviction in the company and the valuation. Their heuristics tend to be more, okay, we know the GP, we trust them, we've been in the last 5 funds, they're a brand name GP, and they do some work around the company, looks like a good company. Other companies like this have done well. It's just not the same degree of rigor as you might see in more of a buyout style diligence, and hence lower conviction. And so they might take a piece of the CV, a small piece of the CV, and they'll size these investments as a very small percentage of the overall fund, which again reflects their level of conviction and the level of work they've done. So then that means there's a lot more room for the syndication and syndicate players to come in, and a need for syndicate players to come in, right? Now, the flip side of it, and then of course there's this, as I said, the secondary market is undercapitalized, right? So that's the second reason. Now, what's going to happen, it's already happening, and we've been one of the drivers of this, is that for the very best companies, if we're coming in as a lead, and we have done all this diligence, we've got a high degree of conviction in the company and in the GP's right to win, well, we're going to lean into that. And so, for example, the first CV we did at SQ, we led it, and then we actually took the whole CV. And they never went to the syndication market, right? And we put some in our fund, we made some available to co-investors, and that was, and so that opportunity, which we think was one of the best CV opportunities in the market last year, never went to the syndication market. So that's a long way of saying, over time, the syndication market is going to face an adverse selection problem. They will see those opportunities that are lower conviction opportunities that lead buyers like us who are capable of doing the full diligence and the work, who are conviction led, decide either not to do or take only a small piece of because you lack conviction. And so that adverse selection problem is going to affect more and more of the syndication market. And over time, the syndicate buyers are not going to have a lot of great options, in my view.
So you believe that this syndication is more linked to the sponsors or the actors having low conviction versus needing to fill the gap of the undercapitalization and the need for more capital?
No, so it's the not sponsors, the lead buyers.
The lead buyers, sorry.
You're not stepping up to take more of it, right? I mean, you'll have secondary funds with like a 20 to 30 billion dollar capital, and they'll write $100 million check, $250 million check, $200 million check in $1 billion CD that they're supposedly leading. That's a very low conviction,
that looks more check, like right? VC investing than PE investing.
Exactly, because they're just building an index. They're building an index, right?
Interesting.
And so the first thing is lack of conviction, but as I said, the second reason is that the secondary market is still undercapitalized, so there's a need for syndicate players. But part of my point is that need for the syndicate players will increasingly be concentrated in the lower quality, lower conviction CVs. And eventually it'll get crowded out as the secondary market gets more fully capitalized.
I want to move on to your personal journey and your vision about private equity and business as a whole and investment decisions. You decided to set up a new firm at a time when, as you mentioned, you have companies that are consolidating and growing bigger, and the market is moving towards larger funds and bigger consolidation. So my question is, what convinced you that that was the time? And once again, what did you see within the secondaries market that made you feel that that was the correct step forward?
By nature, I'm a very patient person. I'm not an impulsive person. But I'm a high conviction person, and that reflects also in my investment style, and I think the SQ investment philosophy. Very discerning, very discriminating, very careful, but do the work to build the conviction and then lean in where it makes sense to. And it's how I thought about my own career as well. I saw over a period of time, I watched, and it just became manifestly clear to me that this was literally a once in a career type of market opportunity that I was staring at in the secondary market. And I talked earlier about why I felt that way about it. And it was also clear to me that, it something that doesn't happen often in a career, that my very particular and in fact unique combination of experiences between being a long-time direct private equity investor and then the GP stakes experience, the familiarity with the funds, underwriting them, relationships with the GPs, then my network. I guess not often in a career does this happen, but it made me almost uniquely positioned to go build that different kind of secondaries firm. And that's what led to the conviction. The market opportunity and then conviction in the product market fit, you could say, between what I thought together with the team I could assemble, could bring to attack that market opportunity.
Being a founder and an entrepreneur, I would say, is a different mindset and skill set than what you had in the rest of your career. So what were the most unexpected challenges that you faced assembling the SQ Capital team and also defining its culture?
It's been an incredible journey, and I would say I think we launched into the right market at the right time with the right strategy and proposition. So I would say it's not so much the challenges, Khalid. It's just there's so much to do, and you want to get after it aggressively without wasting time. And I'm very just grateful and proud for how much we've accomplished since we started the firm in January of last year. But it's that there's not enough hours in the day. There's not enough hours in the day, especially when you're blessed to be in a market that is so overflowing with opportunity. But in terms of, I think, on the team, on the culture, I would say our ability to attract talent, the likes of which you've never seen in the secondary market before, right? And you don't find any other secondaries firm. I think one of our biggest competitive advantages is the type of talent, the training, I mean, right? The type of talent we're able to bring in and there's a pipeline of it, right? We have 3 more people joining us in the coming months on the deal side, all of whom come from really blue chip direct private equity backgrounds, and very well trained, know how to analyze companies, know how to value companies. So I think that has gone extraordinarily well, and I think part of that I would attribute to the flywheel effect. Once you assemble a core team that is clearly a high caliber team that's on a mission, that tends to attract others. It gives the inbounds we get and often through our network. In fact, almost everybody we've hired came through my and our collective network. Give us access to a pipeline of talent that I think is very differentiated and gives us an edge. And then on culture, this is a really important one as a founder, as an entrepreneur, because one of my observations from a long career at and then interacting with some of the best firms in the industry was that and this came to me later in my career. You know, it took some maturity and I think a bit of a bird's eye view to really appreciate this, was that the biggest differentiator between the great and the good in private equity is culture. You know, a lot of good investors, a lot of highly analytical, careful investors who can do the math and do the analysis and so on. But culture was a differentiating ingredient that led to persistent excellence. And so I made it a point that when as I was laying the groundwork for the firm, we actually have, you'll rarely see this. I don't know you'll ever see this at other new firms. We have a senior advisor for culture and talent, right? Who I brought in because I wanted to very deliberately build a particular culture from day one. Because if you leave your culture to kind of happenstance, you wake up one day in a culture that you don't like, and then fixing that is really difficult. So we spent a lot of time and energy as a team, and with the help of our senior advisor, to really define the culture, the values we're all signing up to, the mission that we all share here, and then anybody who's joining the team, really screening them for that fit with that culture, and then making sure that we can always, when something isn't quite working the way you want it to, you can always refer back to that defined culture and that set of values. It's on our kitchen wall here in our office, right? You always refer back to say, okay, that's our kind of, you said that's your measuring stick. Did we live up to these values or not? And if not, what should we be doing differently? So that's been really important, and also I think very enriching. And I think that's also been a big attraction for many of the people who've joined the team, because they've seen that we're really not just talking about this stuff, but really emphasizing it.
But it's extremely interesting and fascinating. And whether it's building the firm or creating this culture, what shaped you as an investor? Do you think it's more the successes, the failure? For you, what was it? Is it more, being successful in certain field, or did you learn more and, being influenced of what you want to do through some of your failures?
Khalid, it's all of the above. It's the successes, it's the failures, it's the near misses, right? And in a long career, you have all of those. But ultimately, this again is part of our advantage, right? Which is that investing it truly is an apprenticeship business. There is no substitute for time and repetitions, and not just your own repetitions, right? You grow up in teams, and you see other people's successes and failures as well. And if your brain is switched on, you're observant, and if you have that learning and growth mindset, you're absorbing not just from your own experience, but from everybody else around you as well. And then the judgment and pattern recognition that gives you, I think that's really powerful and important. But then also there's a key ingredient, which is often found on the margin, right? Because ultimately the investment decisions are often made on the margin. And that's where the gut feel comes into it. But it's not just this, it's not this kind of arbitrary gut. It's just, you have to train the gut feel, right? to listen to your conscience, to listen to that voice, and stay objective at all times, right? And so that, again, experience, repetitions, time and repetitions, right? And of course, time and repetitions under great mentors, under great investors, and that's been one of the privileges of my career. I've learned from some of the greatest investors of the past, half century, and it's been that a great privilege. And then, of course, the opportunity to then impart those learnings to a next generation. That's also a really fun part of the job, and to do that in a smaller, younger firm with a more of a kind of family style environment, it's really fun.
You talked about the different paths you took throughout your career, whether it was direct investing, GP stakes, and now secondaries, and each has its own complexities. But is there, you would say, guiding principle or philosophies that have anchored you through these transitions?
I think, again, it's ultimately part of it is they're guiding principles, I think you could say, right? One is that quality matters. And I think I talk about this a lot. I write about it a lot. I probably overuse the word quality, but ultimately, a high quality business bought at a reasonable price it will work out well. Sooner it might go through some bumps, but ultimately it'll work out well. But you can't really you have to buy low quality or overpay, then you're counting on getting lucky. I don't like to count on getting lucky. That's maybe one way to express that principle. Don't count on luck as an investment strategy, right? Buy quality, do the work. But I think one of the lessons I try and teach to the younger members of our team, I say it a lot, is that in the investing business, the winners are often the people who have the intellectual rigor, the honesty, the equanimity to ask that extra question when everybody else is tired of, tired in the diligence session, when the other side has given you an answer that gets you 85% comfortable but hasn't quite answered your question. It's that stamina, the perseverance, that intellectual curiosity, right? That doesn't let you rest, that says, no, I really appreciate everything you said, but can you please clarify this? That is, in my experience, where I found, when I talk about, on the margin, that's the margin in many cases, where you ask that extra question and you learn something that actually gave you more conviction, or that actually gave you a bit of a yellow flag and a thread to pull on. So those are some of the lessons.
You said earlier that everybody can basically work a spreadsheet and today, and probably with AI as well. But how much of this person-to-person feel plays a role today when bringing in a new partner or acquiring a business and investing in a CEO to lead it?
It's critically important. You have to sit across from a human being, look them in the eye, understand their body language, hear the tone of their voice, and then also get to know them as human beings, right? And I think so much of our diligence advantage, Khalid, comes from the fact that we have close relationships with the managing partners and the senior deal partners at all of these firms. And so when we're trying to get information, whether it's on the underlying portfolio companies of one of their funds that we're trying to buy an LP interest in, or we're doing a CV with them, that relationship built over decades in many cases, right? The transparency that gives us, the candor that gives us, the bit of extra information it gives us. In a secondary market where information is your scarcest resource, right? That's an asymmetric information advantage that we have. And it comes because of the relationships.
We took a lot of your time today. Thank you so much, Mustafa. But
Really a pleasure.
I want to close on the Gulf region, which is becoming increasingly an influential and important hub for private markets globally. From your perspective, how do you see this region fitting your strategy at SQ Capital? And would you ever consider establishing a permanent presence there?
First of all, the region is close to my heart. I spent my childhood in the region, in fact, and have a lot of friends there. In fact, we at SQ have many good partners there. And I think, as you well know, the role that the region has played now over the past 15, 20 years, and increasingly so over the past decade in global capital markets, is truly transformative and really impressive. And having had a bit of an insider's view on it because of all of my friendships and relationships in the region, I regularly have since I was a child. It's been really impressive to see. Asked your question about a permanent presence, we'd certainly be open to that. And step by step, where we have to walk before we run. But that's something that we'd be open to, and in probably quite a substantive way, right? Not paying lip service in the sense of putting a marketing person on the ground, but truly trying to build a real team there as well, as and when it makes sense to do so. There's a lot of talent in the region, along with the capital, obviously, and I think we would have a bit of an edge in harnessing that relative to other GPs.
Thank you so much for your time, Mustafa. Really appreciate it.
Really a pleasure. Thank you for your time, Khalid. Thanks for having me.